On July 13th, the Bitcoin market experienced a sudden, violent downward flush. This decline was driven by a deterministic liquidity sweep, a targeted algorithmic hunt, rather than random market volatility. This heat map shows the immediate aftermath of that drop. Notice the complete empty void in the price action below the $62,000 mark. But if we rewind the clock 20 hours prior, this exact same space was packed with dense, tightly clustered leverage. What mechanics transform these tight clusters of leveraged positions into combustible fuel for trading algorithms? Unpacking this process reveals that these violent flushes are actually matters of mathematical inevitability. To understand how this works, we have to establish what this heat map is showing. The y-axis tracks the asset's price, while the color gradient, shifting from dark purple to bright yellow, tracks the estimated leverage. When you see a thick, bright yellow band, you are looking at a massive, localized concentration of liquidation triggers for over-leveraged traders. Retail traders mistake these dense clusters for structural support, assuming the market will bounce off them. In reality, these high-leverage clusters act as gravitational attractors, drawing algorithmic price action directly toward them. In order to fully see how the July 13th flush executed, we need to forensically deconstruct the preceding 5 days and watch exactly how this liquidity was stacked, baited, and ultimately ignited. To understand this trap, we must start by rolling the timeline back to July 8th, long before the ultimate flush executed. This chart shows the initial market state. The price action is sandwiched exactly between two distinct pools of liquidity, trapped in a compression zone between $62,000 and $64,000. Notice the distinct yellow bands solidifying near the $63,500 and $64,500 marks. As algorithms and retail traders box the price in, these leverage clusters become heavily concentrated. From an institutional perspective, those upper bands represent trapped, highly leveraged short positions waiting to be squeezed. Over the next few hours, the price trends downward and briefly teases the $62,000 level, threatening the lower liquidity pool without fully committing. The market then consolidates between $61,000 and $63,000, building tension and allowing even more leverage to accumulate on both sides. This localized clustering of leverage creates a tightly coiled spring, guaranteeing a violent expansion. By July 10th, the chart shows an aggressive push upward as the algorithm locks onto the upper liquidity pool and climbs towards $63,000. As the spot price pierces the first yellow band, the trapped short positions are forced into automated market buy orders to cover their losses. The price begins to oscillate right around this level as it consumes that newly triggered influx of buy liquidity. This wave of forced buying is exactly what large players need. It provides the necessary volume for them to offload their own long positions without causing negative slippage on the charts. The market temporarily stabilizes near $63,000 as it digests the initial sweep. But then the price spikes again, shooting directly toward the heavily defended resistance zone at $64,000. The price officially breaks above $64,000. Look at how the upper leverage bands on the heat map have now been thinned out and entirely consumed. We can see the final high leverage clusters forming near $63,500 and $64,500, created as a direct result of this push higher. This upward sweep successfully weaponized short liquidations, demonstrating that forced buying is the primary tool for institutional exiting. Over the next 2 days, the price drifts sideways around $64,000, establishing a false sense of an elevated, stable floor. This upward action convinces late-stage market participants that a larger macro breakout has started. We can see the physical evidence of that sentiment right here. The sudden formation of new, incredibly dense yellow bands significantly below the current price. These late buyers are using high leverage, stacking their liquidation triggers perilously close to the spot price. The market hovers flatly near $64,500, looking incredibly stable on the surface, while these highly vulnerable long positions pile up underneath. The center of gravity, the target, has shifted. The magnet is no longer above the price, it is squarely below it. Then we see this sharp probing drop down towards $64,000, testing the waters of this newly built liquidity pool. By engineering a false breakout, the market successfully baited massive long leverage, methodically assembling the exact fuel required for a severe flush. On July 13th, the trap springs. This chart shows the price as it abandons the $64,500 highs and plunges straight towards $62,500. The exact moment the very first yellow liquidation band is pierced, a deterministic cascade begins. The first triggered liquidations force market sells. That instant influx of selling drives the spot price lower, which immediately trips the next set of liquidation triggers, repeating the cycle. The price enters the highly combustible, tight lower range between $62,000 and $63,000. We see a relentless descent as the algorithm plows straight through successive leverage bands, driving the price towards $62,000. There is a slight temporary bounce off the $62,000, a brief pause as the execution algorithms catch their breath. Right before total consumption, you can see the final, thickest yellow liquidation bands heavily clustered right at $62,000. And finally, we arrive at the aftermath. The price becomes range-bound, bordered by empty purple space, with the entire lower liquidity pool completely wiped out. This drop functioned entirely as the mechanical, sequential execution of automated market orders, cleanly and efficiently clearing the entire heat map. Over just 5 days, we watched a full cycle execute: the consolidation, the trap, the sweep for exit liquidity, and the inevitable flush. Modern financial markets are expressly designed to seek out liquidity. They function as complex search algorithms hunting for volume. The progression of these 26 heat maps proves a very clear rule. In the short term, density equals destiny. The heavier the concentration of leverage at a specific price point, the higher the mathematical probability that it becomes the next target. Price action doesn't avoid these dense bands out of resistance, it actively hunts them for survival. This reality undercuts traditional charting. Trying to predict directional moves based on fundamentals is secondary to simply tracking the physical location of the liquidity. The modern quantitative edge comes entirely from probabilistically mapping these inevitable algorithmic paths before they execute. Recognizing the buildup of the magnet on the heat map is the only way to ensure you aren't caught on the wrong side of the sweep. Ultimately, in a highly leveraged ecosystem, you are either the one mapping the liquidity, or you are the liquidity being mapped.